Retirement planning, the way that most people are doing it, sort of the old way, does it really work? We don't know if it works or not for various reasons. In this video, I'm going to share with you what we learned about retirement planning, the old way versus retirement planning, the new way, and what totally worked for us after we accidentally stumbled into early retirement just around age 50, and we began implementing strategies that took us from a really uncertain financial future to financial independence, using both traditional and alternative retirement strategies and income strategies that are completely ignored really in traditional retirement planning. In this video, I want to share with you, in hindsight, after this long journey, maybe I can save you some time in seeing what really worked for us and what's worked in the past 2 or 3 decades that's still prevalent today, and looking forward, well, what worked for us, but also I think what we have to do is looking to the future and seeing what's working now as it transitions into the way that kind of the normal way that things are moving forward. Change is slow, right? And we tend to look at the past and keep doing it until we just sort of, I don't know about you, but I'll just hit myself over the head like 50 times before I go, wait a minute, I've got to change this. And I think that everything happens in that way. And I think the old way of retirement planning is dated for various reasons that I'm covering in this video series. And I'm sharing with you what we found worked for us. Okay, so let me jump into the very first one. And oh, let me remember to tell you, make sure you stay to the very end. The last one is the most important for you to implement any of this that you're hearing here, okay? So the very first one is, the old way is decreased income versus increased income. Okay, so decreased income was cutting expenses. It is cutting. This is the plan. You cut expenses across the board, 20%, 30% once you retire, because you no longer need that money, or you're going to have to cut back, buckle down, and cut, make do in your golden years, or silver years in my case. The new way of retiring, and what we found to really work, is to focus on increased income instead of focusing on cutting back, for so many reasons. When you focus on, I think that conscious spending is super important. I don't want to ignore that. But I want to say that when you focus on increased income and saying, how can I increase income, instead of just making the assumption that all I'm going to have is retirement income, retirement withdrawals, and maybe, if you're lucky, some kind of pension or some other income coming into you. When you shift and go, how can I increase income, a world of possibilities opens up. And that's sort of what we did around age 50 when we started all this, and we ended up creating these income strategies that did completely replace old job income and exceeded it later in life, after we were 50 years old. So this really works. We're not, this isn't something that I've made up. This is something that we've done and it works. So when you shift your thinking from decreasing income to increasing income and asking how you can make that happen, that's the new way, and that's the way to a more certain financial future. Because when you have increased income, you don't have to withdraw as much to live every year and use those standard retirement account withdrawals that we all probably have heard about, that 4%, 3%, 4% a year to live in retirement. The second element of retirement planning, the new way versus the old way, is fixed income assets. From the old way is fixed income assets from bonds or maybe annuities versus income assets that increase in value over time. Let me expand on that a little bit more. You may have a retirement asset, or be thinking about, or have looked at in the past, typical retirement asset is something that doesn't fluctuate in value very much because you want that safety, right? And so that asset though, what it does bring to the table is it pays you income. But income is extremely low nowadays, which is why we have to shift all this to a new way of retiring that works. That asset, not only is it going to stay steady and not increase in value, say maybe it maintains a $10,000 asset value, it'll pay you that income of say 3% or 4% over time. That's sort of the old way. And the old way was to say, well, you've got this income, right? And that's what you really want after you retire. You don't really want to focus on wealth building because now you're at the income phase of your life where you're going to just live off your money and let it pay you income, and or you're going to use retirement withdrawals. The new way is buying assets that will increase in value while also paying you income. An example of this might be, or an example we've experienced, has been buying real estate rental property that pays us income and it increases in value over the years while we own that property. So we like that better than something that we don't know. Well, we know it's probably not going to increase in value, and while we own it and while it's paying us that income. Let me also just throw out here, because I can't resist diverting into this unplanned topic, is that inflation is such a big factor here. Because if we have an asset that's not going to increase in value and that fixed income is not going to increase in value, and we run into a period of rising inflation, which is not that unusual. If we look at history, 5, 6, 7% inflation is not rare, then we're going to be in real trouble. Whereas if we have an asset that increases in value and pays us income, then there's a good chance, as in the case of real estate rental properties, that value will rise with inflation, right? The value of that asset rises, it's inflationary, as well as the rent is inflationary. So that's another reason why we need this shift away from the old way of looking at things and doing things to this new way of doing things, because, well, to us, it certainly seems like it's less risky, right? All right, the next thing I want to address in here is, cookie cutter investing models versus personalized wealth plan. All right, so sort of the old way of doing things is that asset allocation, you've heard me say here 60% or 70% or whatever it is for you in stocks versus 30%, 40% in bonds. Usually the bond allocation is increased after you retire because you're looking, as I was saying in that earlier last one, the fixed income. The new model, though, is based on personalized wealth plan. All right, and that's sort of what I do at Retire Certain. It's working with clients. It's saying, and it's what we did. It's saying, what are your assets as far as investments? What are your assets as far as skills? What is the lifestyle that you want? What are your goals? And then how can we make all that work? How can we create a personalized wealth plan to help you get what you want while you can pay for it for life? Instead of, doesn't that feel better than that old cookie cutter of, I've got to settle for this, I've got this asset allocation, and I'm going to stick with this no matter what happens, versus a wealth plan that is all about you, what you want, what works well for you based on your skills, your interest, your level of net worth, your financial goals, something that's much more personalized and tailored. There's a shift toward that, and we can see this from the younger generations who are buying real estate rental properties. They're creating online businesses. They're using or taking advantage of Airbnb to rent out a portion of their home. They're being creative and innovative. It's a move away from that standard of everybody doing the same thing and putting that 60% in stocks, 40% in bonds, or whatever it is, right? That whatever the asset allocation is, into what opportunities are there, what do I see, what works for me, what are my skills, how can I best utilize all this to create financial independence for myself. That's the shift we're seeing, and I think it's very exciting. All right, the next one I want to share with you is a shift away from the old way, the 401k, the with limited options, the pension plans, the high fee investment options, to more diverse low fee investment options, and what that can, look like really low cost ETF, tactical asset allocation strategies, right, that we can now do as personal investors because of the internet, because we have this fantastic information available to us that was not available to us even a few years ago, a decade ago. The amount of information that's become available to us as individual investors to make choices around our investments that we used to have to rely on those institutions create for us to limit our investment choices for us. Now we have all these ways that we can make our own investment choices. Not only that, they cost a lot less than the old way of doing things. And so now we can take advantage of this, and that's a fantastic thing that's happened that's now available to us. But the old mindset, especially my age, the over 50 generation, I'm well over 50, as you can see, it's still looking at that because that's what we've known. There's this thing called recency bias, and it leads us to invest around what's happened lately instead of seeing the opportunities that are presenting themselves as the change is happening. So that's a huge shift that we can take advantage of. And then the last super important thing that I want to share with you that I mentioned is so important that you really have to be aware of before any of this can take place is moving from fear-based versus proactive-based investing, okay? So let me expand on that a little bit. When we stumbled into early retirement, and I had implanted in my brain that, we would just live off the interest from our bonds, right, and our dividends in retirement. The old way of doing that we looked at was saying, wait a minute, I don't know if this will work. It was scary to us, right, because we didn't know. It related to all these factors outside of our control, whether it was the stock market entering another bear market or two in one decade like we saw in the first 2000s decade, or whether it was interest rates dropping to nothing where we used to be able to rely on fixed income for bonds for decent income and now it's nothing, or runaway inflation like we saw around 1980, over 13%. Is that insane? When my parents had recently retired. So we don't know, and that's scary. That's fear-based. But when we take these steps to do something other than what is out of our control, beyond our control, influence beyond our control, to things that we see are opportunities and we can be more involved with the outcome, then it's proactive, right? We're proactive when we go, what else can I do? I see that this 4% retirement withdrawal thing is not going to work for me. What else can I do? And what we did was we looked at different options, and we started out looking at buying 2 local businesses, and we seriously considered that, applied for the loan, saw that we had to put up so much capital, we would have been wiped out if those small businesses that we were looking at buying didn't work out. That was way too risky for us. So then we ventured into some oil partnerships, and then we ventured into real estate rentals, and then gradually we got into online business, years later, and it all, not all, I wouldn't dare say it all worked out. A lot of it didn't work out, and that's why I like to share with you what did work out and what I learned from this, maybe to save others from some of the pain from what didn't work out. But a lot of it did work out, and this is all doable for anyone now looking to create a retirement plan that's based on what's happening now and the future versus what used to work 2 or 3 decades ago, right? If you like this information, found it helpful, you'll like the other information that's related in this series right here. Make sure you watch it next.